Right now, in 2026, most people are exhausted. On any quiet morning, they are scrolling through their phones, chasing the next big thing, or panicking about a headline that will be forgotten by lunchtime. There is a gap. Let us call it the noise gap. On one side, you have the noise, the crypto tips, the property gurus, the constant, deafening sound of everyone trying to get rich by Friday. On the other side, in the quiet, you have the wealthiest families in Britain, and they are doing something remarkably boring. They have stopped betting, and they have started positioning. They are not searching for a lottery ticket. They own 3 specific British engines, 3 companies quietly building wealth in the background, while everyone else is distracted by the storm. And by the end of this video, you will understand not just which 3, but the exact mechanical reason they work. Here is the trap that catches the average person. When most people think about British investing, they look out of the window. They buy what they can see on the high street. The bank on the corner, the supermarket they shop in, the builder down the road. They invest in the visible economy, the one tied directly to how much money is in a British wallet on any given Tuesday. And that is exactly why they struggle. Because when the British economy catches a cold, their entire portfolio sneezes. The wealthy do the opposite. They do not buy what they see, they buy what the world needs. This is the global Britain filter, and it is the single most important idea in this entire video. The richest investors in the United Kingdom do not bet on the British high street. They buy British domiciled companies, companies with a London headquarters and a place on the FTSE 100, that earn more than 80% of their revenue in dollars and euros. British on paper, global in the bank. Think of it like this: a standard British job or a small local business is like standing on the ground. You feel every storm, every change in temperature. Every drop of rain the British economy throws at you, you get wet. When interest rates rise, you feel it. When the high street slows, you feel it. These 3 stocks are different. They are like a high-altitude weather balloon. They rise up above the local clouds to 30,000 feet. Up there, they catch the global trade winds, the enormous currents of money that blow across the entire planet. You are still British. You still take off from British soil. But your momentum is no longer tied to the rain falling on London. Let me show you the 3 balloons. The first is the defensive fortress, AstraZeneca. This is the largest company on the FTSE 100, and it sells something the world will always need, in good times and in bad: medicine. In the first half of 2026, its total revenue grew by 6%, and its core earnings per share climbed by 11%. But here is what the wealthy actually watch: the pipeline. Management has pointed to more than 20 late-stage trial readouts across this year alone, with real momentum in cancer treatment, and it has reaffirmed an ambition to reach $80 billion in annual revenue by the end of the decade. Now, the dividend. AstraZeneca has raised its payout for 5 consecutive years. For a wealthy investor, that steadily rising income stream acts like a safe harbor, a place to anchor money that keeps lifting its payout year after year, helping to offset the slow erosion of inflation. It is not a firework, it is a fortress. It does not depend on you feeling rich. It depends on the world needing to be well. The second balloon is the industrial turnaround, Royce. A few years ago, this was a struggling giant. In 2026, it is one of the most talked about industrial stories in the city. In the first half of the year, its underlying operating profit jumped by 46% to £2.5 billion, and the company raised its guidance for the full year. 2 engines are driving this. The first is power systems, which builds the heavy-duty power units the world suddenly cannot get enough of, including the electricity that feeds the enormous data centers behind the artificial intelligence boom. The second is defense. In this tense geopolitical climate, governments across Europe are rearming, and Rolls-Royce recently secured one of the largest defense contracts in its history, around 200 power packs for German military vehicles, with production capacity being expanded to deliver them. When nations decide to spend on security, they do not shop on the high street. They come to engineers like this. The third balloon is the quiet giant, Unilever. You may not own a single Unilever share, but you almost certainly own its products. Walk into any bathroom or any kitchen on earth, and you will find its brands: the soap, the shampoo, the tea, the ice cream. This is what analysts call a brand moat. Unilever owns the shelf space of the entire planet. And that ownership gives it a quiet superpower: pricing power. When costs rise, a company with a brand moat can pass those higher prices directly to the consumer because people keep buying the brand they trust. In the first half of 2026, its most important brands, which now make up around 78% of the business, grew by 6%. Its leadership recently said that around 90% of its revenue is now sitting at the price it wants, up from little more than half just 2 years ago. That is a machine that quietly turns global inflation into rising profit. So those are the three engines. But here is the part the average person always misses. The wealthy do not just own these stocks, they wrap them. Because owning a great company is only half the game. The other half is keeping what it pays you away from the taxman. And this is where HMRC comes in. The tax-free dividend allowance, the amount of dividend income you can earn each year before tax, has been quietly shrinking. Just a few years ago, it stood at £5,000. Today, in 2026, it is only £500. Everything above that gets taxed, and the rates on those dividends went up again this year. So, what do the wealthy do? They shield it. They hold these three stocks inside an ISA, the individual savings account, where you can shelter up to £20,000 every single year. Inside that wrapper, every dividend and every pound of capital gain is completely invisible to HMRC. Others use a SIP, a self-invested personal pension, to do exactly the same thing for retirement. Same great engines, zero tax on the fruit they produce. And that is the real magic of it. Investing in these three giants, wrapped in an ISA, is like owning an automated greenhouse. You do not check the soil, you do not water the plants, you do not run the company. Thousands of employees and a team of world-class chief executives are doing all of that for you. You simply own the infrastructure, and every 90 days, like clockwork, the fruit, the dividend, is quietly harvested and dropped into your basket. You are not the farmer sweating in the field. You are the owner of the greenhouse itself. Picture it. The start of a new financial quarter. Any quiet morning, you are making a cup of tea, and money simply arrives, not from your labor, not from your postcode, but from global contracts signed on the other side of the world. Now, I know what the noise says. These three are not exciting. You will not see them trending on TikTok. Nobody is screaming about them, promising to 10 times your money by next month. But here is the mathematics. The loud voices never show you. Take the fruit, the dividends, and instead of spending it, use it to buy more trees. This is called dividend reinvestment. Every payout buys you a few more shares. Those new shares then pay their own dividends, which buy even more shares. Then those buy more still. It is a quiet loop that feeds itself, and over 10 years, it bends into a curve that almost every get-rich-quick scheme fails to beat, because those schemes usually end at zero, while the greenhouse just keeps compounding. Slow is not weak. Slow, compounded, and untaxed is how real British wealth is actually built. Because in the end, wealth in Britain is not really about your salary. It is about decoupling. It is about cutting the rope that ties your future to your postcode, and tying it instead to three global engines that keep turning no matter what happens in Westminster. AstraZeneca, Royce, Unilever, a fortress, a turnaround, and a quiet giant. Three balloons that carry your money up above the rain and into the global trade winds. And once they are giving you enough oxygen to breathe freely, regardless of what the government does next, that, quietly, is what real freedom looks like. Of course, every balloon can lose height. The value of shares and the income from them can fall as well as rise. And this is a story for education, not personal advice. But the principle the wealthy live by does not change. Stop betting, start positioning, and let the greenhouse do the work. If this video helped you, like and hit subscribe. I'll see you in the next one.